While the world watches the strikes on Iran, the oil price spike, and new threats from the US, a far more dangerous picture is emerging in the market than it first appears. Because right now, we're not just talking about a local military conflict in the Middle East. Right now, before our eyes, a situation is unfolding where geopolitics, energy, the US economy, and the movement of big money are all starting to pressure the markets at once. That's exactly why what Bitcoin is doing these days looks so unusual. You'd think that in this environment, risky assets would have entered a deep correction long ago. Oil prices are staying very high. Talk of a potential US ground operation in Iran is getting louder and louder. Tens of billions of dollars have flowed out of US funds in 2 weeks, and fresh data on the US economy shows that the slowdown hasn't just begun, it's becoming increasingly apparent. But despite all of this, Bitcoin isn't crashing. In fact, it's holding steady, as if the market still hopes the worst-case scenario can be avoided. And that's exactly what we need to understand first. Why, amidst war, high oil prices, and rising tensions, hasn't Bitcoin dropped as many expected it to? Why doesn't the stock market look like full-scale panic is about to break out tomorrow? And most importantly, what happens next if Trump actually takes that next step and the Fed signals its rate and future monetary policy in just a few days? Because if we look at the situation realistically, the main question now isn't whether there will be volatility. There will be volatility either way. The real question is which specific trigger will prove decisive for the markets. Military escalation, another oil spike, Powell's hawkish rhetoric, or all of the above. That's when we'll see why Bitcoin is holding up for now, while remaining in a state of very fragile equilibrium. Regarding Iran, it's crucial right now to separate the sensational headlines from the actual baseline scenario. Yes, the possibility of a ground operation is being discussed more and more frequently. Yes, after the airstrikes, the US gained air superiority, which theoretically opens a window for a limited ground mission. But that doesn't mean Washington has already decided to move into Iran with a massive force. Quite the opposite, actually. For now, it looks more like the White House is keeping a short, targeted operation in reserve just in case the airstrikes didn't achieve their primary objective. And that primary objective, as I've said before, isn't to occupy Iran or to take full military control of the country. The main issue is the nuclear program. If some of the critical material actually survived, if some uranium stockpiles and infrastructure were predispersed or hidden deep within protected facilities, then the United States has a problem that cannot be guaranteed to be solved by airstrikes alone. This is exactly where this whole story of a ground operation comes from. In other words, we are not talking about a classic invasion along the lines of the Iraq scenario, but about a much narrower task of localizing, seizing, or destroying what could in the future again become the basis for the Iranian nuclear program. And this is where a very difficult choice begins for Trump. On the one hand, he understands that a long war would be toxic for the American economy, especially if oil continues to go up. On the other hand, to leave the issue of nuclear materials open is to admit that even after a series of strikes, the goal was not fully achieved. Therefore, my basic scenario remains the same. Trump is unlikely to go for a major land war, but he is indeed keeping a short targeted operation on the table as a backup option. And for the markets, even this is already enough to keep tensions at a very high level. Because the very fact that such a scenario is not off the table means a constant risk premium in oil, constant pressure on inflation expectations, and constant nervousness across all risky assets. And here we move on to the second part of this picture, the United States economy. Because while everyone is discussing Iran, the numbers within the states themselves are starting to look less and less comfortable. The economy is already showing a rather sharp slowdown. And this is not just ugly statistics on paper, it is the foundation on which market expectations for rates, liquidity, corporate profits, and the stability of the entire financial system are built. When growth rates cool so noticeably, investors begin to factor in more unpleasant scenarios in advance. That is why we saw a strong outflow of money from American funds and stocks. This is not a story about a one-time profit-taking. It is a story about big money starting to behave more cautiously because they sense increased risk. When tens of billions of dollars leave funds in a short period of time, it means that some market participants no longer want to hold their positions as confidently as before. They are not necessarily expecting an immediate collapse, but they clearly understand that the environment is becoming much more unstable. And against this backdrop, the picture for Bitcoin indeed looks paradoxical, because instead of a strong capitulation, we see that capital continues to partially flow into crypto exchange-traded funds, and Bitcoin itself maintains its resilience. Why is this happening? Because the market doesn't fully believe in the worst-case scenario yet. Investors see high oil prices, the risk of escalation, and weak economic figures. But at the same time, they understand something else. If the United States economy actually starts slowing down faster than the Fed expects, at some point it'll bring a shift in Fed rhetoric closer. And that's where the whole paradox lies. Bad data right now simultaneously scares the market and supports it at the same time. It scares because it heightens recession fears, but supports because it creates hope that tight monetary policy can't last forever. And Bitcoin, as we've seen many times, loves to live on expectations of future liquidity, even if that liquidity hasn't arrived yet. The market itself is capable of pricing it in ahead of time. But there's one very dangerous fork in the road here. If oil keeps going up, if the Middle East conflict enters a harsher phase, and inflation expectations creep up again, the Fed will be literally trapped. On one hand, the economy is slowing. On the other, a signal too dovish from Powell amid high oil could be seen as a mistake, meaning he might keep the hawkish tone longer than the market wants. And that would be a bad combination for risk assets, including Bitcoin. So the Fed meeting on the 18th is not just another formality, it's one of the key points for the coming weeks. The rate decision itself might not be a surprise, but all eyes will be on how Powell describes the current picture, how seriously he views the economic slowdown, and if he'll highlight oil-related inflation risks. How will he comment on the resilience of the labor market? And will he give even the slightest hint that the tightening cycle is reaching its limit? Looking deeper, the market today is effectively living in two time frames at once. In the short term, it's pressured by oil, Iran, a strong dollar, fund caution, weak macro data, and the risk of the Fed staying hawkish longer. But in the medium term, the market is already trying to look further ahead. It's trying to understand not tomorrow, but months from now. If the economy keeps slowing, if the labor market cools more, if the corporate sector struggles with expensive money, pressure on the Fed will only grow. Not necessarily as an immediate rate cut, but at least through a change in tone, a shift in rhetoric, and laying the groundwork for a future pivot. And that's exactly why Bitcoin is essentially staying in the game right now, because big capital doesn't just buy for today, it always tries to enter where a new flow of liquidity might appear in 6 months or a year. Yes, right now interest rates are high. Yes, inflation still isn't letting the Fed relax. Yes, oil poses a huge risk of a new round of price pressure. But if Bitcoin continues to hold its structure even against this backdrop, it means part of the market is already looking past the current fear and trying to price in the next cycle. But there's also a very dangerous trap for the bulls here. The mistake many market participants make is starting to trade the future reversal too early, forgetting they still have to survive until then, and the path there could be very unpleasant, because there's always a time gap between a weak economy and actual Fed policy easing. Sometimes it's weeks, sometimes months, and sometimes even longer. And throughout this entire period, the market can live in a state of nervous turbulence, where any bad news knocks the price down, and any hint of easing pushes it back up again. So instead of a clean trend, we get a heavy, choppy, and nervous market with a very high number of false moves. That's why I say the main thing for a trader right now is not to fall in love with a single scenario, because the market hasn't given a final answer yet. It hasn't confirmed a sustained breakout to the upside, nor a capitulation to the downside. It's as if it's stuck at a point where both sides still have valid arguments. The bulls say the economy is slowing down, meaning sooner or later the Fed will be forced to ease, and Bitcoin is already starting to price that in. The bears counter that inflation remains high, oil is rising, and the dollar is strong. The Fed is trapped, which means the room for real growth is currently very limited. To be honest, both sides are right in their own way right now. So when it comes to the structure of the movement, for me personally, the key question in the coming weeks won't even be whether Bitcoin reaches $75,000. It's much more important to see what happens after that. If the market does indeed rise to the 75,000 zone and then starts receiving more hawkish signals on macroeconomics or geopolitics, that's when we'll see how real this growth was. Because a strong market usually finds buyers quickly after local profit taking, while a weak market starts to crumble after hitting resistance, and each new bounce becomes weaker than the last. And here I'd also like to highlight the behavior of ETFs and spot capital, because right now that's exactly what's serving as a sort of anchor of stability for Bitcoin. When, against a backdrop of panic, war, expensive oil, and a nervous dollar, money still continues to flow into Bitcoin-related instruments, even if not in massive volumes, it creates a sense that major players aren't yet ready to completely abandon the growth scenario. Yes, this doesn't mean they'll hold the price forever, but it does mean that at this stage, the market is still getting support that prevents sellers from simply pushing it down with a single move. To sum up this whole picture, in the near term, the market remains squeezed between hope for a future pivot in Fed policy and the fear that before that pivot happens, the economy and geopolitics will still have time to deal a serious blow to risky assets. Bitcoin is withstanding this pressure for now, that's a fact. But another fact is that its margin of safety is being tested literally every single day right now. And the longer such a tense environment persists, the stronger the next major move will be once the market finally chooses a side. So personally, I continue to keep a close eye on several things at once. Oil, because it remains one of the main triggers for inflation and the dollar, the Fed's rhetoric, because that's what sets the framework for liquidity, and the behavior of ETFs, because it's the best indicator of big capital sentiment. And of course, Bitcoin itself around key levels, because that's where, rather than in loud headlines, the market will ultimately show who's really in control of the situation, the buyers or the sellers.